Hello, this is Mark from tradinform.com and welcome to this video on how to trade using standard deviation channels. In this video I'm going to talk about what are standard deviation channels, quickly talk about how we can calculate them for ourselves using Excel, and then I'm going to discuss and demonstrate a trading strategy, a method of trading using standard deviation channels. So firstly, standard deviation channels. Well, the most significant thing for me is that the channels are a dead straight line. Unlike Bollinger Bands, envelopes, moving averages, they follow a directly straight line throughout the period of the channels. However long or short the channels are, they will always be dead straight. The reason for this is because they are located above the channel lines. The upper and lower lines are located above and below this central line, which is a linear regression line calculated using the least squares method. What this means is we have a line that is always straight and is always the best fit for the data over the period that we're using. So this line is a statistical tool, but what myself and lots of other traders find is that it very often, particularly when we are having a up or a down trend, very often this line shows a very nice fit and gives us a very good idea of what the trend is. So we, as traders, we're using something that was not developed for this purpose, but we'll find that, or a lot of people find that it is very useful, and because it's calculated automatically, it automatically adjusts to the data and the market. It's very quick, and it's a very nice way to get a quick view of what is going on in the market. Now, these are standard deviation channels, and again, the statistical tool of standard deviation is used to locate the upper and the lower lines of the channel. Now, standard deviation measures essentially the volatility, how spread out the data is from the average, so that the bands, similar to Bollinger Bands, the channels rather, expand and contract depending on how volatile the market is over this particular period. The bands that I'm using on this chart are located one standard deviation above and below the linear regression line, which means that if I just move them over here, we'll quite often get data above and below the channel lines. You can set this to 2 standard deviations and you would expect to have something like 90% of the data within the channel lines. 3 standard deviations, you'd expect to have 95% of the data. So this is a personal preference, but I like to have the channels fairly tight for viewing the market like I am doing at this moment. So how can we calculate them using Excel? Well, I'm not going to go over this in detail, but it really is quite simple. If you look at the function bar here, we use the line st function to calculate. We need 2 things. We need the slope and the intercept, and we use the index to get the line st function number 1, and then line st function number 2 is the intercept. Standard deviation again can be calculated using an Excel function. stdevpa is the one that I'm using here, and the data range is 100 bars. So using those 3 formulas, we can very easily calculate the upper and lower channel. If you'd like more information about how to calculate standard deviation channels, it is one of the indicators featured in my ebook, How to Calculate 21 Technical Indicators Using Excel. It's available in the Amazon Kindle bookstore, and there is a link on the screen for more information. Okay, so back to the charts. I said that I'm going to talk about and introduce a trading strategy using standard deviation channels. Now, this is quite a straightforward trading strategy, and what I'm trying to do is identify those times when the market is in a buy the dips mode or a sell the rallies mode. So we can see, if I move this on again, we're definitely in a buy the dips mode here. We can see the trend is definitely upwards, and we have lots of opportunities to buy the dips. If I scroll on a little bit further, we have the second quarter of 2015 starting to kick in here, and we have, this is the DAX index here, and we start to see a downward channel developing. At this point, although we don't know it of course until the channel line actually turns over, we're moving into a sell the rallies market. So one of the simple and most important things of this strategy is trade in the direction of the channels. Very simple. The market is moving upwards, and this is quite a slow indicator to change. So it's not trying to pick any tops or bottoms. It's really trying to identify the dominant trend throughout. If the channels are pointing upwards, trade long. If the channels are pointing downwards, trade short. Now we want something a little bit more precise to help time our trade entries, so I've chosen the stochastic oscillator. Stochastic oscillator, very popular indicator, momentum indicator, looks at how much the current close, how the current close relates to the previous closes relative to the highs and lows. One of the advantages of using the stochastic oscillator to time trades is that we can use a crossover. So we have two lines here. We have the main line and we have the signal line. And in this strategy, we take, when the channels are pointing upwards, we take entries when the main line crosses over the signal line. When the channels are pointing downwards, we only take short trades when the main line crosses down below the signal line. So quite a straightforward trading strategy. The only proviso to that is that we have to be more careful, mostly in when we're trading indices, using any method at all really, because the markets tend to move slowly upwards but can quite often move violently and quickly downwards. So we're going to be more picky, more careful with our short trades, and in this case we're only going to take trades, short trades, when the market is below this center line, this linear regression line. Okay, so apart from that, we're going to use positions are going to be closed using a stop loss and a profit target, and I'm going to demonstrate or show you the results that I got using this trading strategy. Now this is a trade informed backtest model, and there is more information on my website if you'd like to click on the link in the screen. What we've got here is the historic data. This is the DAX from 1991 to 2015. We've got the stochastic oscillator here in blue. In white here we have the standard deviation channels, and right at the end we have the ATR or average true range, which I am using in this strategy to set the stop loss and profit target levels. Okay, so this in green and red is the trade informed backtest model that I'm using to test it. Now this model can be used to test a huge range of different trading strategies, and again, as I said, there is information on the Trade Informed website. So using the conditions that I said, these are the results that I got from the trading strategy. starting with $100,000, the net profit over the time period, which was quite a significant time period, 1991 to 2015, was 406,000. What I find most interesting about this particular trading strategy is we can see it here. There is very little drawdown. If we compare it to the underlying market, there are times here we go from 8,000 down to just over 2,000. Again, we have another crash from 8,000 down to about 4,000. This was the Great Recession, financial crisis crash. This was the dot-com bust here. And we have the extremely strong recovery since 2009 shown here. I've used, as I said, profit target and stop loss and trailing stop both set at 5 times the average true range. And these are the results. Profit factor quite healthy, showing we have a higher good ratio of gross winning trades to losing trades. Max drawdown here 37%, which is quite reasonable over a very long time period. Most of the time, in fact, we're actually moving upwards. An average profit for trade. If I scroll down to have a look at the long trades and short trades, we can see that, well, unsurprisingly, most of the profit has come from the long trades. Again, looking at the underlying market, we can see exactly, well, we can see probably why that is, in that the market spent a lot longer moving upwards, and from below 2,000 to around 10,000 is quite a significant gain over time. However, we have still made profits on our short trades, which is good, and we can see that these probably occurred during these big long sell-offs here. In fact, if we try to match up this, we can see that strategy performs pretty well in the bear market as well as it does in the bull market. However, much less overall net profit, mostly because we are slightly stricter in our short trades because of the dangers of stock indices tending to go upwards over time and making it slightly more difficult and a different proposition to trade short. So there is the trading strategy that I am suggesting using standard deviation channels and the stochastic oscillator. If you'd like more information about trading the financial markets, trading strategies, and using Excel to backtest trading strategies, please go to www.tradeinformed.com.